Macroeconomic links between countries are expressed through two accounts, the current account and the capital account. The current account reflects the net exports of goods and services, as well as investment income and transfers. The capital account, which here includes the financial account, tracks investment flows like FDI and portfolio transactions. It is important to note that these accounts are designed to be mirror images. If a country has a surplus on the current account, it must have a matching deficit on the capital account. Any change in one account induces an equal and opposite change in the other. For example, if a country like Australia runs a persistent current account deficit because it imports more than it exports, it must attract foreign capital, which is a capital account surplus, to fund that deficit. As a portfolio manager, you would look at whether Australia's interest rates or investment opportunities are attractive enough to pull in that foreign capital. If they aren't, the currency, Australian dollars, must depreciate to restore balance. Net exports are typically the most significant part of the current account and contribute directly to a nation's aggregate demand. National income accounting shows that net exports, X minus M, are equal to net private saving, which is S minus I, plus the government surplus, T minus G. Because of this relationship, any change in net exports requires a change in either private saving, the government surplus, or both. This is how domestic economic changes are transmitted to the rest of the world. Consider a country with a high government deficit and low domestic savings. The identity shows that this country will likely have a trade deficit unless private savings increase significantly. This helps in evaluating sovereign credit analysis. If a government is borrowing to fund consumption rather than investment, it signals potential long-term currency weakness and higher sovereign risk. A capital account surplus is the mechanism a nation uses to fund investment and government spending that exceeds its domestic savings and tax revenue. Because the current and capital accounts are mirror images, we can reverse the signs of the national income equation to describe the capital account. Essentially, the capital account represents the financing side of a nation's international economic activity. For example, if a country is funding its excess spending through foreign direct investments, like a multinational company building a factory, it is considered sticky and positive for the economy. However, if the surplus is driven by portfolio investments, which are hot money in the stock market, it can exit the country quickly, leading to high volatility and potential liquidity crisis. There are four primary ways the current and capital accounts are kept in balance: changes in income, relative prices, interest rates and asset prices, and exchange rates. These mechanisms do not move at the same speed. Investment markets adjust much faster than the real economy. In the short run, interest rates and exchange rates adjust to keep the capital account in balance. Meanwhile, the current account moves more slowly, reflecting broader business cycles and long-term economic trends. Because financial markets adjust faster than the real economy, a change in monetary policy, like the Fed raising rates, will cause the US dollar to spike immediately. This is the capital account reacting. However, the current account won't improve immediately because it takes months for companies to change suppliers or sign new export contracts. So keep in mind that asset prices and exchange rates do the heavy lifting in the short term to maintain the balance of payments.